So, today, February 23rd, 2026, the global markets gave us a real head-scratcher. It was a complete tale of two worlds. While markets in the US and Europe were deep in the red, Asia was lighting up with green. In this explainer, we're going to break down the powerful forces that are pulling the market in opposite directions, and, more importantly, what it could mean for the weeks ahead.
Okay, let's just dive right into the numbers, because they really tell the story. On the very same day, you have the Dow Jones plummeting 1.66% and Germany's DAX dropping over 1%. But at the exact same time, Hong Kong's Hang Seng just soared over 2.5%, and South Korea's Kospi also had a solid day. I mean, it's a complete divergence.
And look, this wasn't just some random fluke. It brings up a really important question. How on earth can major global markets move in completely opposite directions like this on the same day? We're going to unpack the two very different shocks that created this split.
All right, let's start with the West. The downturn wasn't caused by just one thing. Nope, it was more like a perfect storm of two major shocks hitting at the same time. One coming straight out of Washington, and the other one, well, that one came from the heart of the tech industry. The first shock hits something called institutional capital. You know, it's a powerful idea from economist Simon Johnson, and it's actually pretty simple. Basically, for investors to put their money into a country, they have to trust its rules, its laws, and its political stability. When that trust gets shaken, so do the markets.
And that is exactly what happened today. Just last week, the Supreme Court struck down the administration's emergency tariffs, calling them unconstitutional. But then, this morning, the White House just went ahead and bypassed that ruling, using this little-known rule called Section 122 to raise the tariffs anyway. This direct clash between branches of government absolutely rattled investors' faith in the system, sending a shockwave of uncertainty that helped send the Dow tumbling.
And if that political shock wasn't enough, there was a technological one right on its heels. It reminds me of what the theorist Gunter Duke said. Markets can go from just being uncertain to being truly unstable. And today, a huge disruption in the AI world pushed a whole sector right over that edge.
So where was the epicenter of all this? IBM. I mean, the stock plunged an incredible 13.1% in a single day. And the reason? A competitor, Anthropic, released a new AI programming language that some are saying could completely change the game, triggering what analysts are calling a massive valuation reset for the entire software industry.
And the pain definitely wasn't limited to just IBM. The shockwave rippled outwards, hitting other giants too. You can see American Express dropped over 7%, partly on fears of what AI could mean for jobs, while Salesforce fell more than 5% as investors everywhere started to rethink the future of the entire software sector.
But while the West was dealing with all of this, a totally different story was playing out in East Asia. Their strength today is so key to understanding the full picture. So let's jump over and see why they completely defied the trend.
A big part of the answer is a classic market dynamic, capital rotation. As the strategist Ken Fisher has talked about, when one market starts to look too unstable or too expensive, that money doesn't just disappear into thin air. It goes looking for a new home. And today, it found one in Asia. And wow, the impact was immediate and powerful. This chart shows the Hang Seng Tech Index just leading the charge, surging over 3.3%. The broader Hang Seng and Korea's Kospi were right there with it, posting strong gains. This wasn't just surviving a bad day, this was a decisive breakout.
Now, in South Korea's case, there might be another factor at play. There's this theory known as Dewey's cycle analysis, which basically looks for these really long-term rhythmic patterns in the markets. And according to that theory, the KOSP is just starting a predicted 9.2-year bull cycle. So this underlying technical strength might be helping insulate it from the shocks we're seeing in the West.
So what we have here are two different worlds. One is being driven by instability and the other one by new opportunity. And that brings us to the million-dollar question. How do you actually build a strategy out of this kind of split? Well, the report lays out a quantitative framework to do just that.
They call the framework instability arbitrage. It's a three-step process, and it's designed to systematically take advantage of the exact market conditions we've been talking about.
All right, let's break down how this actually works. Step one is about arbitrage, basically capturing that performance gap between the rising Asian markets and the falling US one. Step two is a hedge on AI. You bet on the innovators while protecting against the decline of the old guard. And finally, step three is a sentiment play, using things like the VIX and gold to profit from rising fear in the market.
Okay, so with that strategy in mind, where do we go from here? Let's look at what the data is forecasting for the month of March, based on today's close.
Now, this is where it gets really interesting. Despite today's big drop, the models are actually projecting a pretty significant rebound for March. They're targeting 51,630 for the Dow and 7,000 for the S&P 500. At the same time, the forecast suggests that rally in Asia still has legs, with the Kospi targeting 6,100 and the Hang Seng aiming for a powerful move up to 29,500.
I know what you're probably thinking. How can the U.S. market get hammered like that and still have a bullish forecast? Well, technical analysis suggests that today's drop was what they call a textbook bullish reset. The S&P 500 pulled back right to a really key long-term support level around 6,800. Sometimes, a move like this is needed to shake out the weak hands before the next leg up. So, if we put all of that into probabilities, here's how it looks. The models are giving that U.S. market rebound scenario a 65% chance. They still see Europe as a bit of a drag, but look at this. They assign a solid 15% probability that the Korean market continues its strong outperformance, which really highlights the potential of that regional trend.
And all of this really leaves us with one massive question moving forward. Today was a dramatic clash of forces: political shocks, tech disruption, regional rotations. Was this just a one-off event? Or is this kind of structural instability, where different parts of the world are moving to completely different rhythms, the new normal we all need to get used to?